Wheat School on RealAgriculture.com is brought to you by Syngenta Canada, Alberta Wheat Commission, and C&M Seeds.
Brian Voth of Prairie Farm Consulting joins us again here on Real Agriculture to talk about what's happening in the wheat market as we head into another growing season. And Brian, we keep hearing about how world wheat stocks are just enormous, how the world is awash in wheat supplies, and yet here in Canada we haven't seen wheat prices necessarily drop off a cliff. Is this all due to currency and what's happening in the currency market?
Well, currency has definitely been one of the bigger drivers on our Canadian grain prices this whole winter. Moving in from 80 cents or 82 cents at the beginning of last year down to 68 in January and now back up to 80 cents. That's a move that's never happened in the dollar side. So it certainly cushioned us when prices went down in terms of the cash returns to farmers. But now when futures are going back up, it's limiting a bit of our upside potential as well. So we've have a bit of a buffer in that sense. Now, with our dollar being as low as it has certainly encouraged a lot of demand, and that includes wheat. We've been very competitive globally in the last year. And on our domestic side, when you look at acreage, which has come down over the years, and our production has dropped steadily since the record 2013 crop, down to last year we were at 22 million tons of production and about a 6 million ton carry-in. Now this year, so far to the end of March, our demand had been 17.1 million tons. If you use a linear demand on that to get to the end of the crop year, that comes out at 25.6 million tons for the year and would leave us down to about 2.6 million tons of carryout. I don't know if it's reasonable to expect that for demand the rest of the year, given where our dollar has moved back to. But nonetheless, our carryout has just come down again over the last 3 years, down to relatively tight levels. Now when you look forward with wheat acres numbers coming down again for this coming year, it's going to just continue to exaggerate that situation. And you look at the Stats Canada numbers of 17.7 million acres, again using a relatively trendline yield for this year, our production comes down by about another 1 million tons from last year. And if our carryout was actually to end at 2.6 million tons, we're down to just shy of 24 million tons of supply for the next crop year. Well, our demand over the last 6 years has averaged 23.2 million tons. So again, that brings us down to about a 700,000 ton carryout, which it had been a long time since we've ever seen a carryout like that. So I don't think some of these numbers are necessarily reasonable to use, but again, it shows that demand has to be rationed, and the Canadian dollar by itself could easily do that as we go forward, because there is certainly no shortage of wheat globally, and it does come down to it comes down to a price market and who can provide it the cheapest to whoever wants it.
So demand rationing, though, that means higher prices usually. How can Canadian wheat keep competing then?
Well, higher wheat prices, depending on how you're looking at it. If you're looking at it again from a currency perspective, if you look at things in a US dollar term, because that's our main competition next door, when we're at a 68-cent dollar or 70-cent dollar, our cash prices are higher, and yet other countries would actually be buying Canadian wheat cheaper because of that. Now with it being back to 77 cents, that's a little bit of a different story. So again, price rationing globally is a little different story relative to just rationing something domestically like canola, which is priced in Canadian dollars. It becomes a little bit more of a convoluted market at that point because there is so much competition.
Mm-hmm. So last year we saw plenty of high protein wheat. Is there any signal at this point as to what growers should be aiming for, whether they should go for yield or protein in 2016?
I don't think there's a signal per se. Definitely last year was a high protein year across the board, and in light of that we did see protein premiums collapse down to very minimal levels, and we saw protein premiums get capped out at lower levels than what we've seen in past years. That's a function of economics. In other years when we've had low protein years, the premiums become quite aggressive. And the reason is, when you've got lots of high protein around, a buyer has no incentive to pay extra for high protein because he has plenty of supply of it. But in a year when you've got low protein and they need the high protein to blend off the low protein stuff, then they're going to pay extra to do that. In general, I've run these numbers for so many years already, protein is never going to pay what yield will. And I know this is an ongoing debate between guys, but when you run the numbers on average protein premiums and discounts, sheer yield is generally where you're going to get a return out of on wheat and not out of protein. Again, there's going to be years where that may not be the case. If, for example, there was a really low protein year and you happen to have 15% protein, yeah, they're going to pay you a lot of money for that protein, but that's the anomaly. That's not the normal. So generally speaking, and that's why you're starting to see these new wheat varieties, which are trending into those higher yields and slightly lower proteins, because that's what the global market wants. In reality, there is no global demand for a 15% protein wheat. That's just not the wheat market. So if you can grow a number 2 13 Pro wheat and grow an extra 10 or 15 bushels of it, pretty much in the long run, you're always going to be better off going that way.
All right. Thanks for your time and your insight, Brian.
Thanks, Kelvin.